Hi friends, no matter when you are watching this video in 2025, this is an extremely important video for mutual fund investors. Have a look at this chart and you will see that since September 2024, market has been consistently falling. Nifty 50 has lost almost 13% from its all-time high of 26,200 levels. There is a panic in the market across all the sectors. For example, have a look at this chart and you will see that Nifty Midcap 150 index has also fallen by almost 15% since September 2024. Although you will see a very different pattern here that back in December 2024, it showed us a very strong recovery. Now have a look at the last chart, which is Nifty Small Cap 250 index, and you will note that from September 2024, this index also started declining, but in December it did a huge recovery back and made an all-time high, fresh all-time high back in December 2024. But since then, it is now down by almost 17 to 18% at the time of recording this video. What does these three charts tell us? These tell us that market is hugely volatile and is likely to remain volatile in 2025. I have created this video explaining you exactly what is going on in the market and why markets are likely to remain volatile throughout the 2025. So billion-dollar question is how to navigate this 2025 when it comes to mutual fund investments. Let me make three hypercritical points. Point number one is do not do a panic sell when it comes to mutual funds. Mutual funds are not trading instrument that you buy them today and then you sell them tomorrow because the market is falling. Absolutely big mistake you will do if you're selling your mutual funds. Point number two is please make sure you continue with your SIPs. You will hear a lot of noise that stop your SIPs in 2025 or exit your mutual fund portfolio. In my view, continuing with your SIP is the best thing you could do because mutual funds generate returns when you hold them for long term. Third hypercritical point is that if you want to do more investments because the markets are volatile or they are down, where to do investments, and this is where exactly this video comes, where I'll walk you through the sensible mutual fund investment options for 2025. If you don't know me, my name is Rahul Jain. I'm a full-time investor and a full-time content creator. I also speak about almost on a daily basis on my YouTube member community. If you're not yet a member, consider subscribing. The feedback has been excellent. By joining this community, you are going to learn practically and are likely to become a better long-term investor. With that, let's get this video cracking. Mutual fund strategy in 2025 will be very different for different types of investors. So in my view, there are four types of investors. Number one is conservative, number two is balanced, number three is aggressive, and number four is ultra aggressive investors. So first one is conservative investors. So conservative investors are those investors who cannot withstand this huge volatility or they are very worried about the markets. If the market falls by even 5%, they are going to have sleepless nights or jittery days. So for them, the best strategy in my view is to stick with either fixed deposits or debt mutual funds because the risk in FDs or debt mutual funds is very low. So the second type of investors are balanced investors. These investors typically have the ability to withstand volatility by let's say 10%, 15%. So if the market falls by 10%, they're still okay. They're not having sleepless nights or jittery days because balanced investors understand that markets go through ups and downs and it is absolutely fine if market is showing the signs of volatility. So for balanced investors, there are three very good options that I want to speak about in this video. Number one is multi-cap mutual funds. There are a lot of misconceptions about multi-cap mutual funds. 3 to 4 critical points you need to understand, which I am going to back with data. So please pay attention. Even if you already invest in multi-cap mutual funds, you are going to learn something new in this next 3 to 4 minutes. First critical point about multi-cap mutual funds is that there are two routes you can take when it comes to investing in multi-cap mutual funds. Route number one is you go passive investing and route number two is you go active investing. In passive investing, you are investing in an index. Which index I'm talking about? Most people do not know what is the index that multi-cap mutual funds follow. So here it is. So the index is Nifty 500 Multi-Cap 50 25 25, meaning 50% of the money is going to get invested in the large cap stocks, 25% in mid cap and remaining 25% in small cap as per this index. Now this index has generated far better returns than Nifty 500 or the total stock market. So from a 5-year perspective, it has generated 23% returns yearly versus Nifty 500 that has given 19.47%. If you look at even longer term than 5 years, you will see 16.62% total returns versus 12.70% of Nifty 500. So all in all, this index has definitely beaten the broader market Nifty 500 500. But when it comes to multi-cap funds, I do not like passive investing personally. Why? Simply because in passive investing, you are sticking to an allocation which is 50, 25, 25. It is very, very rigid allocation and it does not take into account market situations. So therefore, my preferred route is active investing in multi-cap mutual funds. Why active investing? Because when it comes to active investing, the only regulatory requirement is that multi-cap mutual funds need to invest 25 in large cap, 25 in mid cap and 25 in small cap, meaning it is a very, very good diversification. And also the remaining 25, it entirely depends on the fund manager to decide where to allocate, and the fund manager is absolutely free to allocate that 25% based on the market conditions. And in 2025, we know that market is more likely to be volatile. Therefore, it makes a lot of sense to go down the active multi-cap investment route. And the second key point here is that active multi-cap mutual funds try to generate alpha, which is better returns than the index. For example, if I talk about Axis Multi-Cap Mutual Fund, in 2024, almost by the end of November, the fund generated almost 40% returns, while the index only managed 29%. So the alpha here was almost 11% up to the November 2024. And this is only possible when the fund manager has the flexibility to play around with that 25%, and depending on the market conditions, they can choose their bets. I can give you a lot of these examples, but the point remains same, that active mutual funds have the capability to generate alpha over the index. Okay, Rahul, so which multi-cap mutual funds are good multi-cap mutual funds? So this is where the third mistake that people make, or the misconception that people have, is they go and compare the last 5 years or 10 years of returns. That is absolutely problematic when it comes to multi-cap mutual funds, because only in September 2020, SEBI came out with this regulatory requirement where multi-cap mutual funds had to stick to the allocation of 25, 25, 25. And SEBI gave these mutual funds time till January 2021 to go and stick to this regulatory requirement. So the returns that we need to look at from January 2021 onwards. So in my view, last 3 to 4 years of returns is what will actually tell you which multi-cap mutual funds have outperformed the index. So here is the data of last 3 years average annual rolling returns that I have taken here, and you will note that there are top 3 mutual funds, which is Kotak, HDFC and Axis multi-cap mutual funds. Now these are not recommendations, but I am giving you some data backed insights. Then comes the fourth big problem in selecting multi-cap mutual funds that people make. They simply go by the past returns. So the past returns do not guarantee you the future returns, but what you can do is you can take indications from the past returns in terms of the consistency of mutual funds. So here, for example, these top 3 mutual funds have done better than the other remaining multi-cap mutual funds, but one factor that people don't consider is the risk adjusted returns, and that's where Sharpe ratio, Sortino ratio comes into picture. Higher the Sharpe ratio, better the risk adjusted returns are. Higher the Sortino ratio, better the risk adjusted returns are. So out of these 3 mutual funds, if you see, Axis has delivered better Sharpe ratio, better Sortino ratio, better alpha in the last 1 year. So in my view, you need to look for the risk adjusted returns, because if you're taking 1 unit of risk, which mutual fund out of these 3 is giving you the maximum returns? So in this case, Axis has definitely generated better Sharpe ratio, Sortino ratio. Again, I'm not giving you any recommendation here. It is up to you which mutual fund you want to go and invest your money, and whether you want to stick to multi-cap mutual fund. But I'm giving you these insights so that you understand how to go about selecting multi-cap mutual funds. Then comes my last point about multi-cap mutual funds. Please make sure you are reading the investing approach of any mutual fund that you want to invest in. Extremely important point that people are not even paying attention to. For example, Axis multi-cap mutual funds investment philosophy, if you go and read, what they're talking about is they are aiming for stable returns. Also, if you read the 5th point here, that they are trying to capture the best ideas regardless of size. So if they were to pick a large cap stock, it's not necessarily they will go by the size of the company or the market cap of the company. They will look at what is the best idea that is likely to perform in this market condition. So whenever I pick any mutual fund, not just multi-cap mutual fund, I definitely go through the investment approach of that mutual fund, and if that resonates well with me, with my thinking, with my approach, then I go with that mutual fund. Again, I've taken few names here. Please do not take any of these recommendations. I've given you some analysis, some insights and some thoughts to consider. Coming back to balanced investors, second good option in my view is Flexicap mutual funds. By the way, they are not in necessarily any order. Flexicap mutual funds are equally important as multi-cap mutual funds in 2025. But why Flexicap mutual funds? Have a look at this chart. You will will see that Flexicap mutual funds comes at lower risk, albeit lower returns than multi-cap mutual funds, and that is why in 2025 it makes a lot of sense for balanced investors to consider Flexicap mutual funds. In Flexicap mutual funds, the fund manager is free to allocate in any proportion in large, mid or small cap as long as the total investment remains minimum 65%. The ground reality in Flexicap mutual funds is, have a look at this data, you will see that 62% on an average allocation goes into large cap stocks. That's why they are slightly less volatile and less riskier than multi-cap mutual funds. But the history tells us that they have generated lower returns than the multi-cap mutual funds. And here is the data to look at the category comparison. Multi-cap mutual funds have given in the last 3 years around 21% returns, while Flexicap managed around 18%. But the key in Flexicap mutual funds is that depending on market conditions, the fund manager can move the allocation based on what they see is the best fit for the market conditions. If they want to go with 100% in large cap, they're free to do that. If they want to go 100% in mid cap, they can do that. If they want to go 100% in small cap, they can do that. So comes the natural question, which Flexicap mutual funds, Rahul? So again, I've done the same logic here. Have a look at my screen. You will see the last 3 years average annual rolling returns. Top mutual funds are JM Flexicap mutual funds, Quant Flexicap, ICICI Pru, Bank of India, HDFC Flexicap, based on the past returns. Does not mean that these will continue to give you future returns as well. Now, out of these 4-5 mutual funds, you will also again note the Sharpe ratio, the Sortino ratio, and you will, for example, see Quant Flexicap mutual fund has got the lowest Sortino ratio, lowest Sharpe ratio, because they are not giving you the risk adjusted returns. That is the key point I want you to understand. But if you look at, for example, HDFC Flexicap fund, it has done better in terms of the Sharpe ratio and Sortino ratio. Now, you don't see Parag Parikh in the top 5 or even for that matter top 10, because if I just scroll down and show you here, it is at number 16 here, because their returns have been lower. But please understand, if you look at their Sharpe ratio, it is 1.44, much higher than all other Flexicap mutual funds, mainly because the risk adjusted returns are much better than many other mutual funds category. So I've given you a lot of insights here in Flexicap category. My preferred choices will be, for example, Parag Parikh, for example, HDFC. These are very good mutual fund houses in my view. Please do not take these as recommendations. Go with what you feel is right for your portfolio. The third very good option for balanced investors is large cap indexes. And in large cap indexes, my preferred choice for 2025 is the simple Nifty 50 index. Allow me 2 minutes of commentary to land a very important data observation that I have. For example, have a look at my screen and you will see since COVID how Nifty 50 has moved up. What you see here is the yellow line. Yellow line is called Nifty 200 daily moving average DMA. Again, don't worry, I'm not going to complicate here. What I'm trying to tell you is that since COVID, if you see, there has been only 5 episodes where Nifty has gone down 200 DMA, meaning whenever Nifty 50 has dropped below 200 DMA, that has been a very logical point for investors to go and pour money into Nifty 50. Now have a look at this chart and you will see that since COVID we have seen 3 things in the market. Number 1 is that we had a clear bull run. The first bull run here you will see, and Nifty 50 did not come down the 200 DMA. In fact, it was very far away from the 200 DMA. The first bull run was followed by the sideways movement, sideways market, and you will see here Nifty came down the 200 DMA at least 4 times. And this sideways movement was then followed by the bull run 2 that we have very recently witnessed, and here Nifty did not come below 200 DMA. It's only the recent time where the Nifty has fallen below 200 DMA, and the question may be that are we likely to see a sideways movement in 2025 when it comes to Nifty 50? Entirely possible. Nobody can tell you whether it will happen or not, but my point is very simple, that in 2025 Nifty is going to give us a lot of opportunities for it to come down below 200 DMA, go back up again, come down, go back up. And whenever Nifty comes below 200 DMA in the past, that has given a better investing opportunity in my view. So the simple thing you need to do is look at the Nifty 200 DMA if you want to time slightly in terms of where the market is moving. But in my view, Nifty 50 remains a very solid asset when it comes to mutual fund investments in 2025, mainly because the risk reward ratio is looking very conducive here. So natural question is, Rahul, which index fund or ETF could we consider? The simple logic you need to take, if you're going via the ETF route, look at the liquidity or the last 3 years average volume, you will get your answer. And if you're looking at the index mutual fund, go with any AMC which is a reputed one and have the lowest expense ratio. For example, UTI, for example, Axis. These are very good AMCs which provide you low expense ratio index funds that you can consider investing. So this is the entire strategy for the balanced investors. Now moving to the third type of investors, which is aggressive investors, and fourth type, which is ultra aggressive investors. I think this video is getting really longer. I do not know what the response of this video will be. If the response is good, I get lots of likes and comments and people ask for a part 2, then I'll come back and present you the part 2 strategy of mutual funds in 2025 for aggressive investors as well as ultra aggressive investors. So let me know in the comments if you would like me to shoot part 2 or not. Based on your response, I'll decide if I were to shoot it or not. I hope you gained a lot of insights. If you did, subscribe the channel immediately. And also if you want to learn practically about stock market, mutual funds, ETFs, etc., consider joining my YouTube member community. You are going to learn a lot. With that, I hope to see you in my next video. Until then, keep rocking.